Are you investing while your credit card is charging 22% interest? That's like trying to fill a bucket with holes. In the next few minutes, I'll show you the exact order that turns that leaky bucket into a compounding machine. Start with a $1,000 buffer, capture your employer match, then move into IRAs, HSAs, and 401ks beyond the match. Most people skip the boring steps and pay for it for decades. If you've felt stuck despite investing, you're not crazy. The sequence is sabotaging you. Follow this order and you'll be ahead of most savers, with the average American saving about 6%. This puts you in rare company. So what's the hidden leak? Let's zero in on the core issue, the leaky bucket, why you're not getting ahead. You could be investing every month and still feel poorer by the quarter. The problem isn't the market, it's the order of your moves. Think of your money like water in a bucket. Your paycheck pours in, you send some to investments. But high interest balances and the lack of any cash buffer act like holes. Water escapes faster than you're filling it, so even when you do a good thing, investing, your total level never rises. You work harder, but the bucket doesn't get any heavier. Here's the math that makes it obvious. A broad market might average around 7% over time. That looks fine on paper, but if a card is charging 22% or more, your net position bleeds. Each dollar you keep invested has to outrun that charge after taxes and fees just to break even. That's not a fair race, it's a guaranteed drag. Meet Alex. Every month, $300 goes to an index fund on autopilot. It feels responsible. At the same time, a $6,000 balance sits at 22% APR. Interest alone adds about $110 a month, roughly $6,000 times 0.22 divided by 12. So while Alex adds $300 to investments, the debt grows at a pace that quietly cancels out most of that progress. Net worth barely budges, and motivation takes a hit because the results don't match the effort. There's another problem tied to cash on hand. 1 in 3 Americans has no emergency fund at all, and the median amount saved for emergencies is only about $500, down from $600 the year before. That thin cushion keeps people on edge and makes every hiccup feel like a crisis. By contrast, Vanguard's research found that most people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those with no emergency fund, the largest boost linked to any financial factor they measured. That buffer doesn't just cover bills, it changes behavior. And behavior is where investors get hurt without a cushion. No cash means forced selling. A flat tire, a vet bill, a copay, something pops up and you liquidate investments to cover it. If the market happens to be down that week, you lock in losses. You're not choosing to sell because it's smart, you're selling because you must. An emergency fund acts as a psychological safety net that helps you avoid terrible decisions when life throws curveballs, reducing the urge to pull money from the market at the worst possible time. It's like building a house on a cracked foundation. The framing might look good for a while, but the first storm exposes the weakness. A routine market dip plus one unwelcome bill and the progress sags. Not because you didn't try hard enough, but because the base couldn't support the weight. So the fix isn't more hustle, it's sequence. Rearrange the moves and the same dollars work harder immediately. Plug the holes first and the bucket finally fills. That starts with a deliberate pause to install a simple plug in stages so compounding has something solid to stand on. Here's how to stabilize the base. The foundation fix, the 3-stage emergency fund. You'll build it in 3 clear stages. First, $1,000, then 1 month of expenses, then 3 months tuned to how steady your paycheck really is. Let's set the structure. Stage 1 is the $1,000 starter buffer. Stage 2 is 1 full month of expenses sitting in cash. Stage 3 is 3 months of expenses adjusted up or down for your situation. If your income is predictable and your benefits are solid, think stable government roles with comprehensive coverage, 3 months can be enough. If you freelance, rely on commissions, or work in a volatile field, plan on closer to 6 months or more. The goal is not a random number, it's a tailored runway that keeps you from scrambling when the unexpected happens. The common pushback is FOMO. What if the market runs while you pause? Here's the trade-off. Skipping a few weeks or even a couple of months of contributions to build the first $1,000 barely moves a decades-long compound curve, but it prevents the kind of setback that forces you to sell later. Over long horizons, avoiding these panic-selling moments matters far more than catching every uptick. A short, controlled pause beats an unplanned, expensive detour where you sell low or borrow high. Now, why $1,000 first? Because a $1,000 emergency without a buffer often becomes $1,000 plus 22% interest. With cash ready, the cost stops at the bill itself. That single difference turns a bad day into a solved problem, not a debt spiral that lingers for months. It also keeps your investments intact during a dip, which preserves future gains you never see on a statement if you had to liquidate early. There's a behavioral edge too. Research ties having at least $2,000 in savings to a 21% higher financial well-being score, the largest boost linked to any financial factor Vanguard measured. That means even the first $1,000 delivers meaningful relief and momentum. It's not just about paying a mechanic or covering a copay. It's about reducing stress enough that you stick to the plan and avoid costly emotional decisions. Make stage 1 a sprint. Automate a temporary transfer on payday into a separate savings account. Stack a short-lived side gig, list unused items online, and cancel recurring bloat you won't miss for a few weeks. You're not cutting forever, you're accelerating a one-time milestone. Hit $1,000, then keep the automation running until you reach 1 month, and finally extend it to 3 months, or more if your risk profile calls for it. As you build, adjust for real-world risk. Unsteady income, dependence, health concerns, and industry cyclicality all push the target higher. More stability and robust benefits let you lean toward the lower end. Either way, once these 3 stages sit in place, you've removed forced selling from your life and put yourself in a position to capture the next most valuable lever without second-guessing. And there's one move that deserves attention even when you're prioritizing the foundation, because it can match your contribution dollar for dollar. Here's where one rule bends, because the math is different. The match exception, the only time to invest before killing debt. Would you ever say no to a 100% return with no risk? That's the one exception that lets you invest before crushing high-interest debt. It's called the employer match, and it's the rare move that changes your results immediately without asking the market for permission. Here's how it works. Many employers add money to your retirement plan when you contribute. You put in a small size of your paycheck, and they add their slice on top, up to a limit. Your first goal is simple. Contribute just enough to capture every dollar of that match before you throw extra cash at debt. You're not overfunding, you're locking in free money that shows up the same day your contribution does. You might be thinking, my card charges 22%. How can investing make sense here? Because the match isn't a bet on returns. It's an instant bump to your deposit. A 50% match turns $200 of your money into $300 the moment it hits the account. A dollar-for-dollar match turns $200 into $400. That's not a projected yield, it's a bigger starting balance from day one. Let's make it concrete. Say you earn $50,000 and your employer matches 50 cents on the dollar up to 6% of pay. You contribute $3,000, 6% of your salary, and they add $1,500. That's a 50% immediate return before the market does anything, and then those dollars compound for decades. Few opportunities beat that, even when you're carrying a balance elsewhere. Vesting is the nuance worth noting. Some plans require you to stay a certain number of years before you own all the employer dollars, often through a graded schedule where you gain a slice each year. Even with vesting requirements, this usually makes sense. The immediate, guaranteed boost from the match often outweighs the risk of not being fully vested if you leave, and you typically keep your own contributions regardless. If you expect to move jobs soon, check your plan's vesting timeline and still weigh the partial benefit you'll retain. Take a straightforward example. You contribute 4% of your salary and the employer adds 4% more. You just doubled the size of your deposit even if markets go nowhere this year. The account balance is larger on arrival. That larger base compounds in future years, giving you more lift than skipping the match and trying to make it up later. Here's the play. Contribute up to the match line first, then direct all remaining cash toward high-interest balances until they're gone. Use paycheck timing to your advantage. Set contributions as a percentage so the match triggers every pay period, and use auto-escalation to bump your rate later without thinking about it. Meanwhile, accelerate payoff with weekly debt payments to reduce interest accrual and keep momentum high. Once the match is secured and the high-interest fire is shrinking, the next decision is where each dollar can compound with the least drag. That choice matters more than most people realize. Next, direct new dollars where taxes and fees take the smallest bite. Tax shields first, IRA, HSA, then max 401k beyond the match. That same dollar can compound faster depending on where you put it, by thousands over time. Account choice isn't a minor tweak, it's the difference between paying ongoing taxes and fees or letting more of your money keep working every year. After you've captured the match and wiped out high-interest debt, the next move is simple. Prioritize an IRA, then max an HSA if you're eligible, and only after that push beyond the match in your 401k. IRAs often beat many workplace plans on cost and flexibility. You can choose low-cost index funds and ETFs instead of getting stuck with a narrow menu and higher expense ratios. Corporate 401ks commonly carry funds charging 1 to 2% annually, while IRAs let you buy broad index ETFs for only a few basis points. That fee gap compounded can mean tens of thousands more in your pocket over decades. A lot of savers overfill a mediocre 401k while ignoring an IRA or skipping an HSA entirely. That's expensive. If your 401k menu is thin or pricey, directing new dollars to an IRA first often gives you broader choices and lower ongoing cost. You keep the match inside the 401k, of course, but for money above that line, the IRA can be the smarter home until you hit the annual max. Now, the HSA. If you're on a qualifying high-deductible health plan, an HSA offers a triple tax advantage: deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. After age 65, non-medical withdrawals are allowed and taxed like a traditional IRA. That flexibility makes the HSA a powerful long-term bucket, not just a medical checking account. Maxing it and investing the balance rather than spending it right away can turn routine healthcare costs into a long-term compounding engine. Consider a simple path. You pay current medical bills out of pocket when you can, let the HSA stay invested, and keep every receipt. There's no time limit on reimbursing yourself for qualified expenses, so you can let that money grow for decades and pull it later tax-free when it helps your plan most. Over a 30-year horizon at a 7% return, consistently maxing the HSA can build well over $400,000 in tax-free money for healthcare, while the average retiring couple faces north of $300,000. The HSA can essentially neutralize that line item in retirement. Roth versus traditional comes down to taxes now versus taxes later. If your current tax bracket is likely lower than what you expect in the future, Roth contributions can make sense. If you're in a high bracket today and expect a lower one later, traditional often wins. Not sure? Split contributions for tax diversification so you have options when you start drawing down. Know the limits so you can shelter more. For 2025, IRAs allow up to $7,000 or $8,000 if you're 50 or older. HSAs allow up to $4,300 for individuals and $8,550 for families if you qualify. 401ks allow up to $23,500 or $31,000 with the 50-plus catch-up. Prioritizing these shelters first lowers tax drag and compounds more of every contribution. With the shelters filled, the next bucket trades a bit of efficiency for something you can actually use before retirement. Now it's time to use the flexible bucket that isn't locked behind rules. Taxable accounts, flexibility without the drag. What's the point of taxable investing if it grows slower after taxes? It's flexibility. You're trading a bit of efficiency for access. Taxable accounts don't lock your money behind penalties, but they do skim returns through taxes on dividends and realized gains. That ongoing skim is why these come after your tax shelters, where growth avoids or defers the annual haircut. Here's the drag in plain terms. In a taxable account, dividends show up and trigger taxes that year. When you sell and realize gains, you owe again. That constant nibbling reduces the base that compounds. By contrast, sheltered accounts let all of the return keep working without those yearly tolls. Over decades, that difference adds up to a lot of money left on the table if you prioritize taxable too early. But you still need a place for goals that land before age 59 and a half. Down payments, early retirement gaps, career breaks, or launching a business don't fit the retirement account rulebook. A taxable account solves the access problem. No contribution caps, no withdrawal penalties. You can scale contributions up or down with your life, and you control when you take gains. Run a simple contrast. Put $10,000 per year away for 30 years at 7% inside a tax-advantaged account, and you end up around $944,000. Do the same in taxable with ongoing tax drag from dividends and capital gains, and you're closer to $700,000. That nearly $244,000 gap is the cost of letting taxes clip your wings every year. The lesson isn't to avoid taxable accounts, it's to use them only after you've maxed the shelters. Design the account to be tax efficient from day one. Favor broad index ETFs with low turnover so they don't kick off big annual distributions. Rebalance with new cash instead of selling whenever possible. When markets dip, harvest losses to offset gains and up to $3,000 of ordinary income each year. But mind the wash sale rule by swapping into a similar, not substantially identical fund. Keep realized gains long-term to qualify for lower capital gains rates, and avoid unnecessary trading that forces short-term taxes. There's also an estate angle most people miss. Assets in taxable accounts can receive a step up in basis at death, resetting cost basis to fair market value. That can wipe out embedded gains for heirs, a benefit you don't get inside most tax-advantaged accounts, so placement here can be deliberate if legacy is part of your plan. For early retirees, Taxable becomes the bridge. Cover the first several years of expenses from taxable funds while you run a Roth conversion ladder behind the scenes, moving traditional balances into Roth at manageable tax rates. That preserves penalty-free access now and positions you for tax-free withdrawals later. To keep behavior tight, separate accounts by goal. One for the home fund, one for the early retirement bridge, one for long-term wealth. Clear labels reduce the temptation to raid future dollars for today's wants. Do this, and the order you follow starts doing more work than sheer effort, so fixing the leak stops being a slogan and becomes a system you can actually run. Wealth isn't only what you buy, it's the order you buy it. Fix the leak first, and compounding finally does its job without working against you. Follow the full sequence, and you're in rare company. Most Americans never move beyond capturing a match and basic IRA contributions, so this puts you in the top tier of savers. Take action now. Build the first $1,000 this week. Capture your employer match on the next paycheck. Automate payments to crush high-interest balances, then prioritize an IRA, max an HSA if eligible, and only then push beyond the match in your 401k. Next, we'll dig into HSA reimbursement timing and tax bracket smoothing to keep more after tax.